Appreciate being here. This is an important topic. The role of banking and what it plays in the American economy cannot be understated. The FDIC, the Federal Deposit Insurance Corporation, was created by Congress to help maintain stability in the financial sector. Several things are currently happening with the FDIC that raise some concerns. Importantly, since 2013, the FDIC has not had a Senate-confirmed Inspector General. I do think that this needs to be put in place sooner rather than later. That is far, far too long. In May, the FDIC reported it suffered five major data breaches since October of 2015, all involving taxpayer personal identifying information. In the banking sector, this is particularly of concern, to have it happen 5 times that we know about. But today's hearing will highlight an area truly undermining our country's financial future. Our local financial institutions continue to drown in a sea of red tape. Well, there has to be regulation, don't get me wrong. There need to be rules of the road, but they need to be fairly administered, and they need to be predictable so that new entrants can also come into the marketplace. Since passage of Dodd-Frank and the implementation of additional policies by the FDIC, we haven't seen our financial sector getting stronger. What we have seen is a drastic decrease in the formation of new banks and an increase in bank mergers and acquisitions. I think my own personal opinion is the systemic risk is greater, not less. As of March 2016, the United States had 6,122 banks. This is the lowest number of banks since the federal regulators began keeping track in 1934. The lowest number. It was a huge drop from 25 years ago when the United States had over 14,000 banks. Some will claim that that was too many. They didn't have the financial strength and the proper deposits in order to cover their potential losses. But this decrease in banks does matter. Competition fosters innovation, consumer-responsive products, and provides more options for individuals who need access to credits. We've had a growing population in the United States of America, and yet less institutions in proportion to that population than in the past. The FDIC is responsible for issuing deposit insurance to new industrial loan companies, or ILCs, or de novo banks outside of the Federal Reserve System. Proof of deposit insurance is a standard requirement for new community banks to receive their stated banking charter. Put in simpler terms, just like the state requires motorists to have car insurance to register a car, you can't run a bank without a proof of deposit insurance. But unlike car insurance companies who will compete for your business, the FDIC doesn't appear to want consumers to have any new banks. The decline in applications for new banks is unsettling. Between 2011 and 2015, the FDIC processed an average of 3 applications per year. Per year! This is a drastic decrease from an average of 219 applications per year between 2004 and 2008. Using the same car analogy, if states suddenly had no one registering their cars because citizens were unable to obtain car insurance, we would all wonder what was going on with those insurance companies. And since 2011, the FDIC has only approved three since 2011, de novo bank applications, and not one ILC application. Not one of them has been approved. This stands in stark contrast to even 2008 when the FDIC approved 48 de novo banks. Further, the banks the FDIC has approved seem only to meet very small niche markets rather than broad community needs. For example, one of the 3 approved banks, this is a good thing, don't get me wrong, this is a good thing, was located in the heart of the Pennsylvania Amish country, meant to serve only that market instead of creating opportunities for competition in more diverse areas. Today's hearing is an attempt to understand why this radical decline in new bank formation. I'd like to understand if the FDIC is truly open to receiving and accepting applications, or if red tape is resulting in interested parties just throwing up their hands and walking away. I'm sure we can all agree that we want secure and stable banks. Don't get me wrong. We have to have the safety and security of stable banks. But we must be sure that the regulator who's charged with allowing new banks to enter the market is not circumventing the process. This results in weakening the financial sector and limiting options to households in underserved markets across the United States of America. We thank the witnesses for being here today. Already the information was provided in the written testimony is very insightful and very helpful, but we do have some serious questions and look forward to the hearing. I'd like to now recognize the ranking member, the gentleman from Maryland, Mr. Cummings.